Yeah, check it on. All right, I think we're live. Here we go. Well, thanks everyone for joining. I appreciate everyone jumping on. I think we're going to take it back to our roots here. Multifamily Financing 101, April 2023 edition. So we've been getting a lot of questions from people about, all right, so what's the best loan type out there and sort of pros and cons. And so we wrote down some of the questions, and we're just going to take it deal by deal. So or loan by loan. So James, you want to maybe kick it off? What's sort of the first loan that we're going to be talking about today?
Yeah, I think before we jump into the loans, I think we had a question about multifamily as an investment.
Okay.
So we talk about why multifamily versus single family.
Okay. So why don't you kick it off?
So what is multifamily, right? Residential multifamily is 1 to 4 units, or residential is 1 to 4 units. Multifamily being two units or 4 units, and then commercial multifamily is 5 units and above. So that's what we do as mortgage brokers. We get financing for 5 units and above because it's not the conventional financing that you get on residential loans. 1 to 4 units, you can get 30-year conventional. You can also get a 15-year. So those are the 2 common types of loans that you get for residential multifamily. So yeah, we'll break down the 4, 5, or 6 different loan types for commercial multifamily that we do, and that's 5 units and up.
Yeah, I mean, some of the reasons I think people jump into multifamily, I would say, number one, you're not your value is based on NOI and not just sale comps. So I think that's number one. You have more control over the value of your property. Economies of scale. I think James, you owned a bunch of different single families throughout DFW and different locations. I mean, sometimes that's a little bit more challenging to manage. So you have the economies of scale of having 50, 100, 200 units in one spot. And then in terms of property management, there's a lot of good property management companies. We'll do a quick plug for the Old Capital Speaker Series at the end of the month. We're going to have 3 property management companies come talk to us about what they're seeing out there. So I think that's probably why. Those are probably 3 or 4 good reasons why people look at multifamily as investment. But then actually one of the biggest benefits for multifamily is financing. So that's what we're going to be coming for. So that's probably, do you want to jump into that now?
Yeah, I guess we could talk about first loan we could talk about is a bank loan.
Okay.
So bank loans are good for people just starting out because you don't necessarily need a lot of multifamily experience. You just need to hit some of the cash requirements, net worth, liquidity, and also looking at the property. So when you hear bank loan, you're gonna think like your traditional 1 to 4 unit financing, but it's really for commercial multifamily. Recourse bank loan is like a 20 to 25 year amortization. It's not a 30-year, it's not a 15-year, even though there are some. The most common is about a 25-year amortization. So the loan payment's going to be spread out over 25 years. The typical kind of loan terms you see on those are, like a 75% is the max leverage that they'll get. So you're going to need a 25% down payment in order to, qualify for that loan or get that loan. So you're going to need 25% down, additional closing costs, and some provide financing for rehab and some don't. So that's bank dependent. Interest only is a big part of why people do commercial financing. So you can get 1 to 2 years of interest only. And that basically says, so you have your loan payment, right? That's amortized over 25 years. So principal and interest will be a certain payment. So what they can do for the first 2 years is basically say you don't have to pay principal for these first couple of years. You're just going to pay the bank interest. So you're not really paying the loan down. You're just paying the bank interest for the first couple of years. That helps lower your payment so that your cash flow can can cover that payment. It just lowers it a little bit. The prepayments are. Go ahead.
Okay. No, you have one more thing? Yeah.
I was just going to go over prepayment is basically step down, or sometimes because it's recourse, there's no prepayment. And step down basically means like if you see like 5, 4, 3, 2, 1, it means 5% in the first year, 4%, 3%, and so on.
So, so what I was going to have you sort of go through sort of some of the advantages and disadvantages, and then I was going to just jump into maybe like a loan, give you a picture of what we a picture of a recourse bank loan that we did. So, can you see that? Okay.
Yeah.
All right. So, so this is a website that I posted pretty much like every closed deal that I did way back when. It's really old, and so I stopped updating it. But I thought we go back to it because it just has everything all on one site so people can see it. So I'll try to make it as big as possible. So this was a deal. So Regency Place Apartments. So it was a 70-something unit deal, and somebody had owned it for like 30 years. Okay, and the P&L was on a piece of paper, and they had all the keys for the apartments in a bucket, in the maintenance shed. And so if we took that piece of paper and said, "Hey, Fannie Mae, Freddie Mac, can you finance this deal?" they would laugh us out the door. So what we had to do was we had to take this to a local bank and pretty much have them underwrite the deal and look at the pro forma. So this was more of a pro forma deal. It was not a based on in-place income deal. And the person who was buying it, it was probably like their first, second deal. And they had ordinary W-2 income. So they had a normal job. One guy was a firefighter. Another person, I believe, was like an IT guy. And those two people sort of partnered on the deal, bought the deal, and used a recourse bank loan because it could not qualify for Fannie Freddie. I believe the occupancy was probably like 75, 80%. So it was below that threshold. And the reason was this person, like if someone moved out, it took them like, 2 or 3 months to turn the unit over to get it made ready because they were doing it all themselves. Right. So that's my example. Recourse bank loan. When you see a deal, I would say under 5 million, that's probably the right time to look at recourse bank loans. Did we go through the rates? What's rates right now in recourse bank loans?
Yeah. So typically the recourse bank loans, they charge them off a prime rate.
Okay.
So typically a point over prime rate. Prime rate's really, it's the best borrowing rate that banks will give to their preferred borrowers. Okay. And so right now we're seeing prime rate around 8%. And so we're actually seeing some bank loans go a little bit below prime, surprisingly. I talked to a bank the other day or last week, and they said they were quoting deals at 7.5% that they could lock upfront at application. So, it's really prime plus or minus 1%. Typically, I would just say prime rate's the interest rate. And then I guess we didn't touch on the recourse part versus non-recourse. One of the disadvantages of bank loan is that it's recourse, which means you have a personal liability component to that. So if they foreclose on the property, they can't pay the loan off, or they get less money from the property than they owe on the loan, then they could come after you personally, your other assets. So that is a downside of a recourse bank loan.
Okay, so just in summary, recourse bank loan, really first, second time guy, property doesn't qualify. You can get higher LTV. They might not necessarily look at 125 cover at the property level. They might look at the global cash flow. So if you have good secondary source of income, they are faster, right? So they can take it through their loan committee, get the deal approved, and then you have a lower prepayment penalty, right? So you typically have a step down. So maybe start at 3-2-1 on a 5-year and sort of work its way down. So that's sort of recourse bank loans. Do we want to jump into the next one?
Yeah, let's jump into agency loans.
Okay. Before we do
So
that, you want to hit? I guess we have a couple of questions here on the stream. So
oh
let's.
yeah, let's hit them up.
Yeah, you want me? All right. So have you seen more banks lending more after they received more money from the Fed lending window? So I think on this one, what we saw, and I can pull it up. I wasn't prepared for all these questions, but the basically what happened was they allowed. So we went through this in a webinar. The banks were allowed to go to the discount window for the Fed and borrow some money, and they borrowed a
Anonymously.
ton of money. Yeah, anonymously. And so here I'll pull this up real quick. Let's see if we can do it. All right, let's see if we can do that. Can you see that PDF now? Try to make it bigger.
Yeah, that looks good.
Okay. So there was a new program where basically the banks could go to the discount window, and they took 150 billion in the last 2 weeks, or last 2 weeks ago, and then they took another 110 billion, and now tracked where did that money go. And so this increase in liabilities is the loans they took. And then where did the money go? You can see here on the right-hand side. So it basically went into cash. And then, probably just over 50 billion went to loans, and then some securities, probably 10 billion or so. So majority of that money went into cash to shore up their balance sheets, the bank's balance sheets, and not into new lending options. So, all right, let's hit the next question. All right, can you read that one off?
Yeah, of only a limited number of banks that can get Fed cash infusion. Bottom line, do you see lending conditions loosen after banks get so much cash from Fed? So are you seeing any lending conditions loosen up because they have more cash on hand?
We have not seen it. We've seen them still be pretty tight. Like I talked to a local bank recently, and pretty much everything was 55% levered on most of these deals, and they were not out there lending at 75, 80%, unless it was a super strong guarantor or somebody with a strong balance sheet. So all right, let's jump in. He's got one more here. Brent asks, if banks get more aggressive with lending, the bid-ask spread is too wide in most cases. Sellers have got to drop their price.
I would tend to agree with that statement from Brent.
So yeah, I mean, what we're seeing, and I'll kill the screen share. We put out a post earlier today just about most of these deals we need to get to 65%, 70% levered on Fannie and Freddie. So this is the math that I was doing in my head. So let's do $10 million price, $7 million. If you need to get to 70% LTV, right?
Yes. $7 million loan, $10 million purchase price, so 70% LTV.
Yeah. So when you look at this, right? So you're saying, all right, if I need a $7 million loan on a $10 million price, what does my NOI need to be? And your NOI on something like this, oops. All right, here we go. Can I edit this? No, here we go. So your NOI, this is like when the teacher like uses that transparency and they're like bringing the paper down. The NOI needs to be 600K to qualify for a $7 million loan at a 125, and that essentially is a 6% cap rate.
What's the interest rate?
I use 5.5. So if $7 million loan at 5.5% interest rate, then that's sort of the there you go. So $10 million price, $7 million loan at 5.5% interest rate, then your NOI is going to be 600,000 in order to qualify for that. So we're going to need a 6% cap rate on that deal to move forward. So, all right, let's jump into who's lending. So recourse bank lending is a little bit harder right now. But definitely still available, but just more selective, maybe lower LTV. So let's jump into the next one.
All right. Should we break down cap rate and valuation, or
no? Let's just jump into Fannie. Yeah,
Okay.
let's go to Fannie.
All right. Fannie Mae is considered an agency loan. So you got Fannie Mae, Freddie Mac, and then Freddie SBL, Freddie Small Balance. Those are the three agencies. So when you hear somebody say agency, they're talking about one of those three lenders. And they're GSEs, government sponsored entities or enterprises. And they basically provide liquidity to multifamily at all times. So even if there's a banking crisis and the banks pull back, the agencies will be there to lend on multifamily, which is an advantage for the multifamily asset class. So back to the first question, why multifamily agency loans is one of the key parts. So I guess we could break down Fannie Mae is one of the agency or one of the GSEs. So we covered the 1.25 DSCR or debt service coverage ratio, right? So they underwrite to that 1.25 DSCR, and they'll give a loan proceeds based on that. So basically, it just says 25. Your NOI has to be 25% higher than your annual loan payment, and that's
Do you want to show an example of that, or just before?
Yeah, I mean, we can kind of talk through it, I guess. So like we could do $1 million.
Here,
You got an example?
Yeah, let's just jump into the example just for the guys who are the state school guys who are a little bit slower. Let's just
we do get at the DSCR question quite a bit, like for people that don't understand it. So
let's go back to the example that we had previous, right? So we had $10 million purchase price, and then we were trying to get to 70%, so $7 million loan at 5.5, right? Yeah. And so a lot of people, so we have just like an NOI calculator here with some of your common terms. And all right, so you need to get to 476, 943 on your amortizing basis, right? So let's say it's 1.2 is your revenue side. We're just going to do this at a high level, 600,000 for your total expenses. So your NOI is 600,000, right? So you're hitting a 125. So you can actually, so the minimum is 125 on these deals. So people are always like, well, if I pay 11 million, can you give me a little bit more juice? Can you give me 70% at 11 million? And let's just go to 11 million, 70%, that's 7.7, right? And so does it qualify? No, it doesn't qualify. So Fannie Mae is going to stick to this 125 debt service in order to make sure that you are basing your purchase. They're looking at in-place cash flow. So that's probably number one for Fannie Mae. In-place cash flow, 90% occupied. So
not pro forma. They're in-place cash flow, looking for that 1.25 debt service coverage ratio, DSCR, and they're basically working backwards to see the maximum amount of loan proceeds that you can get, and that's a fixed number, or that's capped. So if the purchase price goes way up, if some seller wants, a crazy amount, the loans are not going to catch up to it. So that's the agencies. The maximum loan amount, let's say it does size, let's say they lower the purchase price, the bid-ask spread lowers, and the sellers become reasonable and they say, all right, I want out of this deal. And they lower the purchase price to like 9 million. So the maximum that Fannie Mae will go is 80% leverage. So 80% LTV. And they also offer interest only, 1 to 5 years, and then really experienced borrowers that have done a lot of business with them, they could probably do even more. But that interest only period, again, is helping you cash flow a little bit better on the deal. Their typical loan terms are from 5 to 12 years. So 5-year, 7-year, 10-year, 12-year loan terms. And that's considered permanent financing in commercial real estate. So if you ever hear someone say, we got permanent debt, permanent financing, it doesn't mean, the 30 years. It means that the term is a little bit longer because short-term financing is like 2 to 3 years. And at the end, even though the loan's amortizing over 30 years, the the term means that the payment balloons. So you owe that at the end of the term. So if it's a 5-year term, year 5, you owe the note, whatever's left on the loan, you owe that at that end date.
Okay. So we got the max LTV sounds higher, right?
Yep.
So instead of 75 at banks, you're getting 80% potentially.
A little bit
You
higher.
have longer IO, so you might be 3 to 5 years on a 10-year term, which is higher. Better amortization, right? So you're getting 30-year AM instead of 25 or 20-year AM. What's some of those are the advantages. What about some of the disadvantages for Fannie?
The disadvantages are like when everybody was buying on bridge loans last year and paying really high prices, the agency loans couldn't reduce or couldn't increase their loan amount, so you're capped. That's kind of the one of the disadvantages. Another disadvantage would be yield maintenance. If you have a 10-year loan and then you have 9.5 years yield maintenance, you could get hit with a prepay if you try to sell early. So 9.5-year yield maintenance, say you wanted to sell, 3 or 4 years in, and then you got 5 or 6 years left of yield maintenance. They're basically taking that, what they would have gotten payments, and trying to replace it. Instead of that collateral, they're going to replace it with treasuries. So they're going to, if you want to break down yield maintenance more.
Yeah, so I pulled up a site, Defease with Ease. This can give you an estimate on your yield maintenance. So we're gonna use that same deal: $10 million purchase, $7 million loan, 10-year loan term, 3 years IO, 5.5% interest rate, and this is going to be, let's say we do the loan, we just closed the loan in March, and now we're going to pay it off after 5 years. So most people's hold period is 5 years, and this was a 10-year loan. So we'll hit the button here. And what's your estimate? I'm not going to hold you to it. What's your estimate for the percentage of the loan amount that the prepayment penalty is? Are you ready? Do you want to?
I'm gonna guess.
Yeah, hold on. Let me hit the button. All right, there we go. All right, let's hit the button. All right, what's your guess? Oh, you can't look now. You can't look.
7%.
7%. It's pretty accurate. So we saw the penalty is right here, $664,000. So 664 over 7 million. So that's about a 9.5% of the loan amount, right? So a lot of times step down will start at 5% and then go down to 1. Yield maintenance will be based off of where treasuries go. And so on this one, let's just jump back real quick and let's say, all right, maybe I only paid it off after 2 years, right? So if you're only going to hold this deal for 2 more years, and you have a prepay in 2025. Let's see, May of 2025. Any guesses on here on the prepay?
Wait, are we selling early or?
Yeah. Someone in 2000. You remember we said survive to 25.
Yeah.
So people are like, all right, I just need to get out of this floater. I go to 2025. Someone brings me a good offer. Now it's time to go. What's your guess here? So last time it was 9% after 5 years. So this is only after 2 years. So
I'm going to say, let's go to 19%.
19%. All right, let's hit the button. Let's see what we got here. $1 million on the 7. So I'm trying to do the math. 14%. So 14% on that one. So not as bad as I thought on that one. So this is based. This at the bottom of this, it always says this is an estimate. This should not be used for. So this is just the ballpark your investment out there in terms of yield maintenance. So but it is significantly higher, right? So these prepayments are higher. Most of the time when we see people out there, they usually do not have this, right? So if you look at most people's sort of cost of sale in their pro forma, year 5, most people do not have a 15% prepayment penalty in their deal. So let's just jump into one. So this was a deal that we did on Fannie Mae, closed back in 2018. So pretty clean deal. I don't know if you've been out to this one. This one's over in Bedford. This was like 150 units or so. And, it was stabilized. It was 90% occupied for the last 90 days. the person who bought the deal was a local guy in DFW, and they had already they had done a couple of Fannie Mae loans. They had partnered with some other people, and then they went off and did this deal on their own, right? So once you sort of get the Fannie Mae card, and now you've done a couple deals, you've been in the business for 2 or 3 years, you can go out and buy a nicer deal like this one. This was sort of late 70s, pitch roof, 90% occupied. Person buying it essentially wanted to come in, finish out the interior rehabs. And so they had like a $5,000 per unit budget on the interiors. And so Fannie Mae financed some of that. And this was back in 2017, 2018, the good old days. I think this was purchased at essentially probably like a 6 cap. And then the debt was at 4.5. So you had
probably 80%.
Yes,
LTV.
Yeah, it's pretty much 80%. So, on deals, they went all the way up to 80%. So on deals like this, it did. So, and I don't know if prices are going to go back to 2018 levels, but this was an example of a Fannie deal that we did back in 2018. So,
hey, I think if we get to 75% leverage on agency, I think we're in a good spot.
Keep going. Yeah. All right. What's the next loan type you want to hit?
Next loan type we can hit is the Freddie Mac small balance loan.
All right.
That's a good one. That's a good one for new investors as well. Kind of like the recourse bank loan, that they will not necessarily need you to have experience. So an advantage would be they would give somebody that doesn't have multifamily experience a shot. That why they call it a small balance loan is because the loan's between $1 million and $7.5 million. So it's a smaller loan size. So they're saying, okay, if you got net worth and liquidity and you can handle this, we'll give you a shot to manage this deal if you have a good property manager. Okay. So that's the advantage. It also underwrites to a 1.25 DSCR. It is also 80% LTV. So there's a lot of similarities between the agencies, but there's just like some little tweaks, like the loan amount, experience levels. The IO might be a little bit shorter, maybe 1 to 3 years. An advantage would be that it's a step down. So you're not going to have that yield maintenance. Right. So it could be a shorter 5 to 7 year loan and then a step down. So if you get a 5-year SBL, you hold it for 3 years, your prepay is only 2%, 1% maybe. And so that's a big advantage. What's another advantage? Let's see.
Yeah, I mean, with the amount, like, I guess it's taking us a little time. We still haven't even pulled up the 10-year Treasury, but the 10-year Treasury seems to be moving like 25 basis points a day. It seems like, and so let's pull up the 10-year and see how it's going today. Got the parachute out at 335 today. So I mean, the 10-year Treasury is moving at like 10, 15, 20 basis points a day in volatility. And so what we're seeing a lot of people do, one advantage of Freddie Mac SBL is they reset their rates essentially every week. And so when you reset your rate every week, then that allows you to lock in your loan application, your interest rate. And so that reduces the amount of cost that you have to bring to the table and the risk in your interest rate.
Yeah. So you could sign up a loan today and under, what is it, 5.5%?
Yeah. So yeah, Freddie Mac SBL, they just dropped their rate probably about 30 basis points this week. So yeah, I mean, you're probably in that 5.5 to 6% range, depending on the market that you're looking at.
Yeah. It's also non-recourse, like all the other agency loans are non-recourse. So that means if you have to get the property back for whatever reason, get foreclosed on, equity gets wiped out, you don't have any personal liability. Your career as a syndicator or multifamily operator could be over, but you're not going to lose any of your personal assets. Okay. Unless there's a bad boy carve out, which means if you're committing fraud, then they can go after you personally.
All right, let's pull this. So let's see. Let's go to. I guess my window's not showing up. All right, here we go. Let's try this guy. All right, so this was a deal that we did down in Houston. So this was Park at Woodland Trails. So we did 80%. This was back in the day. 80% for essentially a first-time investor, and they used third-party property management and bought the deal. And it was one of those, you could fix the rate right at the loan application, so you took the interest rate risk off the table. And the loan application fee for Freddie Mac SBL is actually pretty low. It might be 10,000, maybe a little bit more, $10,000 to $15,000, and that's like all your third-party costs. That's your interest rate lock. So a lot of times when you're going hard with a lot of money, earnest money on these deals, the last thing you want is another 100,000 for your loan application fee. So Freddie Mac SBL allows you to do that. And remember, in most markets, it's going to be $1 million to $6 million, and then in your larger markets, your top markets, it's going to be 6 to 7. It goes all the way up to $7.5 million. So I think this is a good loan product for a lot of people who are just getting started. You get longer term fixed rate, non-recourse, and then they actually have what's called a hybrid product, where you can fix the rate for 5, 7, or 10 years, and then it'll float thereafter. And then so your total loan term is 20 years, right? So everyone this year is talking about the wall of maturity that's coming up, and a lot of times the issue that people have is they just hit the maturity at the wrong time. And so when you hit the maturity at the wrong time, that's going to put some stress on the system, and you might have to sell the property at the wrong time and lose money in the deal. So we don't want that to happen to anybody. So all right, let's see, what's the next loan type after Freddie Mac SBL?
That's the Freddie Mac conventional. So it's similar to Freddie Mac SBL, except the loan is above $7.5 million.
Okay.
Or would you say $6 million in secondary markets?
Yeah. So anything above Freddie SBL, then I would go Freddie Mac conventional. So, but keep going. Maybe since we touched on Fannie Mae, maybe touch on some of the similarities and differences between Freddie Mac conventional and Fannie.
Yeah, so I think a lot of times when people do Freddie Mac, they do the Freddie Mac floater, which has a low spread, like I think you can get down to 225, but 250 to 300 basis points over the index SOFR. So that's a really good spread, where bridge loans, our spreads are 3.5 to 4.5, and they're widening out. So that's a good advantage of Freddie Mac. I think Fannie Mae does a floater too, but they're not as competitive on pricing or terms. You can also lock the index.
That's right.
If you pay 2% of the loan amount. Trying to think any other advantages, disadvantages.
Yeah, I mean, I think on the let's hit advantages first. The one more other thing is Freddie Mac's a little bit more flexible on that net worth and liquidity. So a lot of times, on Fannie Mae loans, let's say you have a $7 million loan, they want $7 million in net worth, right? But on Freddie Mac, as you go up the scale, so let's say you're doing a $20 million loan, Freddie Mac might only need like a $10 to $15 million net worth on you versus the 20 million. So Fannie Mae is pretty strict about the net worth piece, and Freddie Mac's a little bit more flexible. So I would say that's one of the big ones. On the advantages side,
somebody's trying to scrape together a team and they don't quite have the 20 million, they can qualify with the lesser net worth.
Right. Yeah, that's right. They can qualify. Yeah, in case instead of bringing in like one more KP to hit the net worth and liquidity,
to take another chunk of the deal.
Yeah, take another chunk of the deal. But then I would say also on the approval side, so Fannie Mae is more of a DUS model, so delegated underwriting, and so Fannie Mae is going to have a little bit quicker approval, I would say, than the Freddie Mac conventional. So Freddie Mac conventional, most of Freddie Mac conventional historically has been more Class A and B, and then on the Fannie Mae side, they've done more B and C stuff. So Freddie Mac, I would say, is probably a little bit, I'm not going to say fancier, but just a little bit higher quality properties out there. So let me see if I can pull a Freddie Mac deal real quick on my. So let's see. This is one that we just did. All right, let's see if I can share my screen here. All right, I just have a picture. It's not on a website, but you were out there at this property, so Bedford Creek. So we did both of these, right? So we did the Freddie Mac floater back in 2020, and that's when everybody was making the assumption that SOFR was going to be flat for the rest of our lives, and so the interest rate cap cost nothing, and so we did a floater. And we put up the COVID reserves and everything. And then in 2022, 23, the interest rate cap escrows, which we've talked about a lot, those just started sort of compounding. It went from 5,000 to 20,000 to 100,000 a month, and it just became too much. And so we refinanced into a fixed rate. And so this one has a Freddie Mac refi and went to a fixed rate, and it was probably around 5.5% on a shorter term. So I think we did a 7-year on this guy, 7.5 maybe on the fixed rate. So I think that's it did take a little bit of time. We sort of waited for the 10-year to dip back in February, and then once it dipped, we just locked the index and moved on. So I thought that was a good execution on the Freddie Mac side.
Was there a prepay on that, or were they, because it's Freddie Mac?
So Freddie Mac had it was a floater, so they usually have a 1% prepay, but then because of the refi to a fixed rate, they were able to waive the prepay. So worked out pretty well. All right, so let's jump. I think we got a couple more. What's the next loan type that we're going to cover?
Non-recourse bridge.
All right, let's go to non-recourse
fan
bridge.
favorite of 2020 and 2021.
All right, so maybe hit the pros and cons on non-recourse bridge.
Pros on the bridge is it's non-recourse, so no personal liability. The leverage is higher than the agencies. They're not constricted by the debt service coverage ratio. They do more of a pro forma. I think it's more of a pro forma DSCR. They look at year 3 and say you can hit a 1.25 in year 3 based on rent trajectory and interest rates remaining where they're at or slightly above. No one really predicted the interest rates going up. So that's why a lot of bridge loans might not be able to refi coming up. But they do pro forma, so you get a higher loan amount. They do financed rehab, which is huge for some of these value add deals. So the agencies aren't going to give you, $1 million in CapEx dollars. So if you wanted to do a big rehab on agency, you would have to raise that money, extra money to do the rehab. Whereas the bridge, they'll earmark it, and as you complete the work and draw down, they'll add it into the loan amount. But they usually give you that 100% financed up front. Another good reason another advantage is the prepay, kind of like the Freddie Mac floater, 1% prepay, so you don't have to get stuck in an expensive yield maintenance. So let's say you hold it for 2 years, the value goes up, or you implement your business plan, you increase the NOI, value goes up, then you can sell that without having a big prepay. So that's one of the big advantages as well.
All right. So why don't you go through this case study since we just closed this loan just a couple months ago?
Yeah, recent deal in Irving, 92 unit deal. We actually did a fixed bridge on that one. So no floater, 3-year term, step down. So 2% prepay year 1, 1% year 2. So kind of not really a big prepay. And then 2 1-year extensions based on a debt yield test. But yeah, it was a 72% leverage at the time when not many people were giving that much leverage out. Agency leverages are still 55%, 60 on the high side. So I think this one qualified for 60% agency, but that extra 12% was I think a couple million. So they didn't have to raise that extra $2 million, and then they had $800,000 in rehab financed. So that's an extra, I think it was like 3 or 4 million all said and done that they didn't have to raise. And so that's another good reason for bridge with the leverage, is that raising capital is extremely difficult sometimes, especially now. So getting that little higher leverage, you might be willing to pay a little bit higher interest rate to get that leverage.
Okay. Yeah, I thought that was a good. Yeah, so I mean, we gave them the option. We said, hey, you can do a Fannie Freddie, be at 60% levered and they were like, well, we didn't want to raise the additional equity at the time, so it's a larger, one investor. Or larger one investor was bringing a large chunk of the equity, and so they wanted to go with a bridge, and so we were able to do a bridge loan where they didn't have to raise all the equity for the rehab, because the rehab budget was a little bit larger than most deals. So
yeah, and
okay.
the fixed bridge basically saved them another, I think it was like $500,000 for 2-year cap at 2%. So I mean, they saved 500,000, and then they would have had to escrow for a third year, which would have been, another 16-20,000 a month for the escrow, just for a 1-year cap. So I mean, those cap costs are really prohibitive on some of the bridge deals for sure.
All right. So we're going to touch on, I think we got a couple more loan types. We definitely haven't done as many, but let's just touch on these two real quick. A lot of people ask me about HUD. You want to touch on HUD, or you want me to go through HUD?
I'll let you go through HUD.
All right. We did an Old Capital podcast on this one, probably about a month or two ago, with one of our HUD underwriters. And, I think there's really two programs out there. There's the 221D4, which is really on the new construction side. So if you're looking for sort of a full amortization, so 35-year fully amortizing construction loan, non-recourse, HUD is a great option. It's gonna only be in certain markets, right? So they're gonna look at sort of a market study and figure out, all right, can I do a deal in Dallas or a suburb of Dallas, or do I have too much concentration risk? So that's probably step one, is 221D4, get a market study. If it fits, then HUD will give you an application from there. The other one that probably has been more interesting is I think it's 223F. And hopefully I'm getting all my numbers right. But 223F is a refi. And what that allows you to do is use a lower debt service coverage hurdle. It is a fully amortizing loan as well. So instead of, like, let's say a 125, you might use like a 118 on HUD. And so on some of these larger transactions, Class A transactions, that maybe you bought it and you had to buy it, you had to use a bridge in the last couple of years, then what we're doing is going to HUD and doing a refi, because you want to make sure you keep that deal. So I think the beauty of HUD is really making sure that you get the proceeds. So a lot of deals we've looked at, and the proceeds were short on Fannie and Freddie, but now we used HUD, and they were able to get up to pretty much cash neutral transactions instead of cash in refi. So HUD has worked well on those two issues in terms of new construction, and then refinance if you are short on a bridge loan. So
how do they do their interest rate? How do they size that?
Interest rate is pretty similar. It's still based on 10-year treasury. Their spreads are a little bit lower. So like, let's say Fannie is 550 today. Their all-in interest rate might be 525. So they're a little bit tighter on interest rate out there. But it still moves with the 10-year treasury as well. So, all right, let's go to CMBS. I have to go find so when I worked at GE Capital and we had a CMBS shop, we always loved to do multifamily. It was my favorite because it was significantly easier to underwrite than an office building or retail building out there, because you didn't have to review 20 leases that were 100 pages each. So CMBS is sort of, you're always lucky, I think, to if you win a deal and it goes CMBS. So CMBS is definitely they're a longer term lender, right? So it's non-recourse. They're going to give you probably most deals are set at 10 years. And they might give you anywhere from 1 to 3 years IO. So let me actually let me see. Actually have
What CMBS stand for? Commercial mortgage-backed security.
security. That's it. So let me pull up a deal. I don't actually have. Let me see if I have a picture of it. But it's actually, we just did a what's the deal on it. It's called Cedar Trails out in Tyler. And so let me pull up. I'll just pull up some pictures of it.
Did we drive out there?
This is a drive-by real quick. So the one thing, so it's out in Tyler. So what you're going to notice is this is a pretty clean deal. Like it was, 1980s deal. Here's some pictures in the bottom. And, it was like 95% occupied when the buyer bought it. And, one of the things that they were looking for was higher leverage. And, they had a set amount of equity similar to Trinity Park. And, one of the things that they kept asking was like, all right, what's Fannie and Freddie doing out in Tyler? And at the time when they bought the deal, they were doing 65% leverage, probably like a 130, 135 debt service coverage. And so they decided, hey, is there any way to get that extra 10%? Like sort of, we talked about it last time. Can we get the extra leverage? And CMBS was willing to do the extra leverage out there. And so we did a 10-year CMBS loan on this deal, and it allowed the buyer to basically put down 25% instead of 35%. So CMBS is going to work when Fannie and Freddie doesn't, right? So let's say if you have an issue at the borrower side, if you have an issue with the it might be a bankruptcy, it might be a foreclosure, it might be litigation on the borrower side or the property side, right? So you might be at 87% or 82% or 83%, but it's essentially a stabilized property and you're ready to go to a stabilized loan product, then CMBS works for that. Whereas on Fannie and Freddie, it would not qualify. So CMBS, I would say, leave it in your back pocket. If you need it for specific case of multifamily, then I think that works pretty well. All right. What do we got? Any more loans to cover, or should we just roll into this next section? I feel like we got a little bit more.
We could do a hard money loan.
Hard money loan. Okay, let's jump into. All right, why don't you cover hard money loan? I did not have that in my list, but let's just do it.
Yeah, I don't think it's on the list, but I just thought of it.
Right.
Hard money loans typically, high leverage, high risk, high interest rate type of loan.
Everything's high.
Everything's high.
All right.
So I don't think I've seen like very large hard money loans. I feel like the hard money loans are more like, five, maybe 10 million and under, where you got a really distressed property that you need a lot of rehab and no other lender wants to touch it. It's too risky. Maybe it's a huge value add or a complete gut. And you say, okay, I think, the property's in a good location. I think if we fixed it up and rented it out, it would be worth a lot more than it is now. Let's reach out to a hard money lender and see if they will give me 100% of the loan, or maybe 90% of the loan.
Right.
And
I mean, we like, where we do a lot of these loans, I would say you're taking probably an older property and bringing it up to standard a little bit. So like I worked on a loan sort of in East Dallas, and there's a lot of properties, I would say, that let's go back one. They had a great picture here of a property that looks like it needs a hard money loan. You see this little property right here? Can you see that property?
Is that a single family?
Yeah, I don't know what that is.
Duplex?
This little smaller. So someone might do, let's say, a hard money loan, and it looks like this, right? And you're like, hey, I need money to take this property and turn it into this, right? So usually on these smaller multifamilies, it might be only like 5 units or 10 units, right? But I did a hard money loan for a guy, and essentially it was like 40% occupied, and the bank wouldn't give him a loan because it was negative cash flow. He didn't have the balance sheet or the income in his tax returns to really qualify for a bank loan. So he used a hard money loan, and it basically took him a year to flush out all the tenants and basically move the property to a stabilized property where it could move into Freddie Mac SBL, right? So he used the hard money loan, took him about a year, did all the rehab, and then he was able to move it into Freddie Mac SBL from there. So I think that's a way. Like the bridge loan is good for 3 years. Hard money loan is probably good for a year, maybe 18 months, because the interest rate. What's the interest rate on hard money loans right now?
I would say 14%, 15%.
Okay. Yeah. So they used to be
maybe 12 on the low side.
Okay, 12%. Now they're going up. So, all right. I mean, any other property types or loan types out there, or you feel pretty good?
So say we cover bank, recourse bank, Fannie Mae, Freddie Mac SBL, Freddie Mac conventional, non-recourse bridge, hard money, CMBS, HUD. Are we missing one?
No, I think we hit them all. So here's the cheat sheet that we've been looking at, and so this sort of outlines the bank loans that we talked about, the Freddie Mac SBL, Freddie Mac conventional, Fannie Mae, non-recourse. So if you want this cheat sheet, we'll make it available for the people who watch this. Maybe just comment below, and we'll send it out to you via email or something. But I sort of give this out to people to keep sort of in their back pocket. So when they're looking through a deal, trying to figure out what the best loan option is, this is always a good one to keep in your back pocket. So. All right. I think that puts us at the hour. I appreciate everyone jumping on. Anything else you want to wrap up with? Any other comments before we jump here?
I'm trying to think. Should we go over like qualifying for the loan or any process of the loan, or you think?
Yeah, I mean, I think we'll save that. Yeah, I think we'll save that for next time, for next week's live. So I think we did pretty good this week. But yeah, any questions on any of these loans or why we did any of them for the specific case studies, I would say comment below. Let us know what type of loans you've done in the past, and it may be something we missed out there. But I think next week we'll get into maybe some deal stories, and then also maybe some of the processing of these loans, because it is important for making sure you understand how to qualify, how to get through the process of the loan, and then some of the best practices we've seen from some of the operators out there.
Yeah, I'll give a plug for Old Capital. So what we started talking about single family and small residential, and then a lot of people move from there to commercial multifamily. So what we do is help those borrowers essentially go through all these loan types, and we really kind of show them which one's the best and which one are out there, what's the going rates. And it's not as intuitive as just going to the bank and getting a 30-year conventional. There's a lot of complexities to it, and that's kind of our full-time job, is to help these borrowers get the right financing and close the transaction, because they're not as easy to close as single family.
Yeah, I'll throw up the slide. I mean, there's a lot of movement out there in terms of 10-year treasury, in terms of what people are using out there. But yeah, I mean, whether it's, podcasts, the conference, speaker series, lunch and learns, we try to get you educated out there up front, so that what the best loan type is. And then we sort of work with you throughout the process to make sure you close on time, because your earnest money's at the title company, and there's a lot of risk once you start going into these transactions. So, all right, I think that'll do it. We'll see you next week.
All right, we got a sign-off call.
No sign-off yet. No intro, no sign-off. But yeah, appreciate everyone jumping on, and we'll see you next week.
All right. See you guys.
See ya.